Okay, so the dollar index is down more than 8% for the year. 8%. That is not a blip. That is not a correction. That is a systematic bleeding of the world's reserve currency. And here's what really gets me. It is only year one of what could be a 5 to 7 year down cycle. Wall Street options traders are pricing this in. They are not just bearish, they are extremely bearish, and they have good reason to be. The structural problems underneath the dollar are rotting away, and the facade that everything is fine is cracking faster than I expected. Stick around, because I am going to walk you through why the 2026 economy is going to feel like a completely different planet, why Japan is about to put Trump in a vice grip, and why silver at $73 per ounce is just the opening act of a much bigger story. Let us start with the Treasury auction that nobody on mainstream media wants to talk about. The US government tried to sell $70 billion worth of 2-year notes last week. 2-year notes are supposed to be the safe, boring, super liquid part of the bond market. They have less duration risk than 10-year bonds, so they should attract plenty of buyers, right? Wrong. The results were a disaster. International participation fell from 57% to 53%. That is a 4 percentage point drop, which on a $70 billion auction means roughly $3 billion of foreign capital just vanished. Gone. Reuters flagged the weak demand. The Financial Times noted the bid to cover ratio was the second worst since 2019, and Bloomberg's bond desk called it a D plus grade. D plus, that is barely passing, and this is supposed to be the safest debt in the world. Now, what strikes me about this is not just the number, it is the signal that number sends. Foreign investors are not just having a bad day, they are consciously reducing exposure to US paper. Why? Two reasons, and both are structural, not cyclical. First, Scott Bessent, the Treasury Secretary, keeps borrowing money as if the printing press has no off switch. The supply of new bonds is endless, which means price discovery is broken. You buy today, and tomorrow there is another auction, bigger than the last one, pushing your bond's value down. It is like trying to fill a bathtub with the drain wide open. Second, the collapsing dollar itself is the incoming train. If you are a Japanese pension fund or a European insurance company, why would you hold an asset denominated in a currency that is bleeding 8% a year? It is not just the coupon payment you care about, it is the total return. If the bond pays 4% interest but the dollar loses 8%, you are net negative 4%. That is not investing. That is donating. So they are walking away, slowly at first, but the pace is accelerating. And once this trend is entrenched, it is very hard to reverse. Dollar down cycles that are structural, not just a reaction to a single Fed meeting, normally last 5 to 7 years. We are in year one, so buckle up. Before we dive deeper into the dollar doom loop, let me hit pause for a second. Look, I know this macro stuff can get heavy, and when you are doom scrolling about currency collapses, it is easy to forget to eat something that is not a frozen pizza. That is why I have been leaning on Mom's Meals lately. They deliver chef-prepared, fresh, balanced, healthy meals straight to your door. No prep, no dishes, just heat and eat. You can get a full week planned out, made with care, and honestly, it is one less thing to worry about while the financial world burns. I've dropped the link in the description. You can get 50% off your first week. Okay, so let us connect the dots between the bond exodus and the tariff war, because this is where things get really interesting. Trump went on his Christmas speech and boasted about taking in $18 trillion in tariffs. 18 trillion. That is not a misquote. He said it. The math obviously is insane. Total annual federal revenue is about $5 trillion. So 18 trillion in 10 months would mean tariff receipts equal to 3.5 times the entire federal budget. That is not possible. It is not even close to possible. But the fact that he is leaning so hard into this number tells you something about the mindset in Washington. They see tariffs as a magic money tree, and they do not care about the downstream consequences. Now, my take on this is that tariffs are not a revenue story. They are a currency flow story. When the US imposes a 45% tariff on a $59 trinket from New Zealand and the consumer still pays it, that tells you domestic prices are even higher. But here is what nobody is talking about. Global trade is shrinking, which means fewer dollars are being exported overseas. The dollar is, first and foremost, America's #1 export. We print it, send it abroad in exchange for goods, and those dollars circulate in the global economy, creating demand for treasuries. When trade collapses, that flow dries up. The world does not need as many dollars, so they stop buying our bonds. It is that simple. China's share of U.S. imports has gone from 25% to 8.4%. You could look at that and say, great, we are decoupling. But the flip side is that China now invoices more trade in renminbi. The RMB has climbed past 7 per dollar, and the yuan is up 4% this year despite China's own property crisis. Why? Because the world needs Chinese goods, and Beijing is saying, okay, you can pay us in our own currency. That sets off a virtuous cycle for Beijing and a death spiral for Washington. More RMB loans are being issued globally. Chinese bond yields are dropping even though they are already low because there is structural demand for RMB assets. Trump's tariff war is accidentally helping China's currency internationalization. The irony is thick enough to cut with a knife. Which brings us to silver, and this is where the story gets really wild. Silver is trading above $73 per ounce. If you bought at the start of 2025, you are up 150%. Yes, that is parabolic. Yes, that looks mania-driven, but you have to look under the hood. The supply situation is brutal. Output from the mines has been flat for 5 years, and industrial demand from solar panels, EVs, defense, aerospace is climbing at 8% annually. The math does not work. Too many buyers, not enough metal. But the real shock is coming from China. According to reports from the Shanghai Futures Exchange, local silver inventories have been drawn down to multi-year lows. The UBS Silver Fund in China is seeing massive oversubscription, with investors paying a 60% premium to net asset value. 60%, that is not rational investing, that is panic accumulation. People are afraid they will not be able to get physical later, so they are front-running at any cost. It is a mania, yes, but it is a mania rooted in a real shortage. What really stood out to me is that Beijing is treating silver as a strategic metal now, not just a monetary or industrial one. Chips, solar panels, missiles, satellites, all need silver. If I were running Chinese state reserves, I would be stockpiling not millions, but billions of ounces. And we are already seeing the ripple effect. Chinese local prices are 10% above global spot. That is a clear signal that domestic demand is overwhelming supply. The West might have 100 paper contracts for every bar of physical, but in China, they are taking delivery. This is how you break a paper market. Now let us circle back to Japan because this is the other leg of the dollar's potential collapse. The Bank of Japan raised rates a week ago, but the market is yawning. The yen has not rallied, inflation is still sticky, and import costs keep rising. My read on this is that the Bank of Japan is behind the curve and they know it. Oil prices are dropping globally, yet Japan's CPI is not decelerating. That tells you the weak yen is the primary driver of inflation, not commodity prices. So what are Japan's options? They have two levers: hike rates more or sell assets. Rate hikes will push the yen carry trade unwind even harder. When yields between U.S. Treasuries and Japanese government bonds narrow, the trade becomes unprofitable. Borrowing yen at 2% to buy U.S. paper at 4%, only to see the yen surge 5%, is a losing proposition. Everyone knows this, so the unwind is accelerating. The Bank of Japan has signaled more hikes are coming, which means more pressure on the carry trade, which means more Treasury selling. But hiking alone is not enough. Japan's gross debt is 250% of GDP, but net debt is 130%. That gives them fiscal room to maneuver, but only if they sell foreign reserves to fund the debt retirement or directly intervene in currency markets. In simple terms, they have to dump U.S. Treasuries to get the cash. They can use that cash to buy yen, which pushes the yen up, which kills the carry trade, which forces more Treasury selling. It is a doom loop, but for the dollar side, Scott Bessent is going to be furious, but Japanese money is leaving the U.S. market sooner than most analysts expect. The Treasury's biggest foreign creditor is about to become a net seller. That is not priced in. That is not in the models. That is a black swan in plain sight. So, what does this all mean for 2026? Let me lay out my roadmap. First, the Treasury auctions are going to get much uglier. The D+ grade we saw this week will become the norm. Foreign participation could dip below 50% by mid-year. Yields will rise to attract domestic buyers, which tightens financial conditions and pressures stocks. Second, Chinese yuan internationalization is going to continue to accelerate. As China invoices more trade in RMB, central banks in Asia, Africa, and Latin America will start holding more yuan reserves. The IMF's COFER data will show a measurable shift away from dollars. This is slow, but it is irreversible once it reaches a critical mass. Third, silver will hit triple digits soon. The supply deficit is real. If Beijing is stockpiling at $73, they will buy more at 80, 90, 100. The paper to physical leverage in the COMEX is so extreme that a coordinated delivery squeeze could send silver to $120 in a matter of weeks. I am not saying it will happen, but the conditions are there. Fourth, Japan will trigger a global bond rout. If the Bank of Japan hikes rates again in Q1 and starts selling treasuries, the 10-year yield could blow through 5%. Mortgage rates spike, corporate credit tightens, and the Fed is forced to restart quantitative easing to avoid a full-blown credit crunch. That would be the ultimate paradox, hiking rates to save the yen, then printing dollars to save the bond market. Lastly, U.S. consumers will feel the squeeze. Tariffs are a regressive tax. The $59 Kiwi trinket with a $27 import duty is just the canary. Bread, batteries, baby formula, everything imported will become even more expensive. Meanwhile, the weaker dollar makes domestic inflation worse because commodity inputs priced in dollars become more expensive for American firms. It is a pincer movement on Main Street. My personal conclusion is that we are at an inflection point. The dollar's role as the undisputed reserve currency is not ending overnight, but it is being chipped away from 4 different directions simultaneously. The bond market is voting with its feet. China is building a parallel system. Japan is preparing to exit stage left, and American consumers are unknowingly funding the whole transition through tariff payments. I think 2026 will be remembered as the year the world started treating the dollar as just another currency, not the currency. That shift might sound subtle, but it changes everything. How Washington finances deficits, how Beijing prices goods, how Tokyo manages reserves, and how you and I protect purchasing power. If I had to give one piece of actionable advice, get exposure to real assets, silver, gold, and maybe some renminbi denominated bonds if you can access them, and definitely keep some cash outside the dollar. Let me know in the comments. Do you think China keeps stockpiling silver at $80? Will the Bank of Japan really force Japan to dump treasuries? I read every comment, so drop your take. And if this helped you connect dots that the mainstream media is ignoring, smash that like button and subscribe. We are in for a wild ride, and I will be here to guide you through it. Stay safe, stay nimble, and I will see you in the next one.